Hello everyone. Today we want to discuss about UiPath company analysis and its investment potential. We will also show you whether it is worthy of investment at current stock prices. So let's get started. UiPath as a company was founded in Bucharest, Romania in 2005 and was incorporated in Delaware in 2015. The company specializes in RPA, which stands for Robotic Process Automation, and currently is involved in end-to-end AI-powered automation. The company provides a robust set of capabilities that allows them to discover opportunities for automation, automate using digital workforce that seamlessly integrates with humans and operates a mission-critical automation program at scale. The platform enables employees to quickly build automations for existing and new processes and to utilize software robots to perform a vast array of actions, including but not limited to logging into applications, extracting information from documents, moving folders, filing in forms, and updating information fields and databases. The ability of the software robots to replicate steps performed by humans in executing business processes drives operational efficiencies and enables companies to deliver on key digital initiatives with greater speed, agility, and accuracy. Now, looking at UiPath's position, UiPath is a market leader in robotic process automation. So if you look at the graph or the chart on the left-hand side, Gartner rated UiPath as a leader in robotic process automation, closely followed by Automation Anywhere and SS&C Blue Prism and Microsoft. On the right-hand side, you see another independent research done by Forrester, which also shows UiPath is an independent leader in robotic process automation, again closely followed by Pegasystems, SS&C Blue, and Automation Anywhere. So two independent IT research companies have rated UiPath as leaders in robotic process automation. So let's look at the market for robotic process automation, how big it is. The robotic process automation market, according to Data Horizon, was valued at $3.7 billion in 2022 and is expected to grow at a CAGR, compounded annual growth rate of 36.6%, which would lead this market to grow to $81.8 billion by 2032. Another agency, Precedence Research, values robotic process automation at $5.63 billion in 2023 and is expected to grow at a CAGR of 28.7%, and the market is expected to reach $54.57 billion by 2032. Another research by Consegic Business Intelligence shows that the market worth of RPA is $2.46 billion in 2022, and this is expected to reach $20.2 billion in 2030 at a CAGR of 30%. So essentially, all the independent research is showing that the market is expected to grow anywhere between 28.7% to 36.6%, which is a very, very strong growth for the RPA market. Let's take a look how big or how far what is the growth rate of UiPath. Now, looking at UiPath for the past 4 years, it had a compounded annual growth rate of 33%, which is in line with the market growth as shown in the previous slides by independent research organization. UiPath has been growing at a quarterly growth rate of 9%, which is very impressive for a company. What we still see is that the net income, if you look at the orange line here, it's still below zero. The net income is still negative. So we will get to that in the net income statement and discuss more about the net income. However, the top line seems to be growing pretty well at a CAGR of 33% annually, which is very impressive. The only concern is net income and how soon and how quick the net income will turn to a positive number, which we will see in the following slides. Now, here's an interesting take. The net income, excluding stock-based compensation expense, is a positive number. So if you look at this chart, UiPath has, in the most recent quarter, it had a positive income of $64.2 billion in terms of net income excluding stock-based compensation expense. So what is making the net income negative is the stock-based compensation issued to the company's employees. We will get more into the stock-based compensation and compare the stock-based compensation of UiPath to other organizations who are in the early stage of their growth. We will get to that in the following slides. So just keep in mind about that, that we will get to that, and also keep in mind that the net income excluding the stock-based compensation is a very, very positive number. If the company had not issued that many amount of stock options to its employees, it would have had a positive net income. Now let's take a quick look at UiPath's income statement. Here we see the income statement for the past 9 months ending October 31st, 2023 versus October 31st ending 2022. The top line grew by 20%, which is very impressive for this organization. Gross profit grew by 23%. What you see here is the operating expenses grew only by 2%, which shows that the company is able to grow its top line by 20% despite growing its expenses only by 2%. And what is even more impressive in the operating expenses line, if you look at it, the sales and marketing expenses declined by 1%, R&D grew by 21%, and general and administrative expenses declined by 9%. So the company is strengthening its competitive position in technology by investing more in R&D, which grew by 21%. But the company was still able to grow its top line despite a reduction in sales and marketing, and despite a reduction in general and administrative costs. So despite the overall expenses grew only by 2%, the top line grew by 20%. Which is very positive, and software companies are able to achieve operating leverage by growing the top line while keeping the expenses very consistent. So if you look at the net loss, okay, the company had a net loss of $123 million compared to $300 million in last year, that is October 31, 2022. So the interesting thing is, if you look at the top line, the difference between 902 and $750 million is roughly $152 million, right? So the company increased its top line by $152 million. And if you look at the net loss again, it improved by close to $167 million, right? So that's the difference of negative 123 million and negative 300 million. So the top line increased by 152, and the impact on net loss has been a change of positive 167 million, which shows that the company is having a very strong operating leverage. That is, all the gains on the top line is being passed on to the bottom line, which is extremely impressive for a company to generate positive net income in future years. That is, the company is able to grow its top line while keeping its cost the same, and it's able to pass all the increase in the top line to the bottom line, which goes straight to the profit line. So here we're seeing a growth of 152 million in top line, that is translating to a growth of 167 million in the bottom line. Very, very impressive, and that is the company is able to achieve by keeping its expenses very consistent, not growing its expenses but growing its top line. So software companies having operating leverage are extremely good companies to invest in, because all the growth in the top line goes straight to the bottom line. Now here are some interesting things about its balance sheet. One thing, if you look at the balance sheet, if you look at its assets and if you look at its liabilities here, the company does not have any debt. So the company did not borrow any money from the bank, and it has a lot of liquidity. So we love companies that have a lot of liquidity. Here it has a liquidity of $1.8 billion in cash and marketable securities, which puts this company in a very stable position from a cash perspective. The book value per stock is at $3.49. So the way we calculate book value is dividing the total shareholders' equity by the total number of shares outstanding. The total shareholders' equity here is 1.961. If you look at the last second line, that's the stockholders' equity, 1.961 $1 billion is the shareholders' equity, and the total stock outstanding is around, which we'll see in the following slides. It's around 567 million shares outstanding, which gets to the book value per stock of $3.49, of which $3.2 is in cash and marketable securities, right? So which is very, very positive for an organization. Now, here's an interesting thing about how much cash is the company able to generate from operations. So if you look at this, the company generated $153 million in cash. The company is generating positive cash flow from its operation. The only reason why the net income is negative is because of a huge stock-based compensation expense of $283 million that it issued as stock options to its employees. We will get to it to show more comparison about whether this kind of stock-based compensation expense is reasonable or not by comparing UiPath's stock-based compensation expense against similar companies who are also issuing stock-based compensation expense. For people who do not understand stock-based compensation expense, it's basically stock options given to employees to retain them, and it's extremely critical for an early stage organization to issue stock-based compensation in order to retain its best and high-performing employees. So if you look at it here, the bottom line is the company is generating a lot of cash. The only reason the net income is negative is because of stock-based compensation expense. Now, if you look at one of the interesting things about the cash that was generated by the company, the company used 2/3 of its cash, or 52.649 million of the 153 million, to repurchase its stock. The company repurchased 52.6 million at an average share price of $17, which indicates that the company believes that the stock price at $17 is undervalued. So this is another impressive way of returning cash, or another way of increasing shareholder value, and also making use of its cash. The company is sitting at a cash pile of $101.8 billion, having no debt, and the company is also generating positive cash flow from its operations, which enables this company to buy back some of its shares, which negates some of the share dilution that is happening due to issuance of stock-based compensation to retain its really good employees. Now, here again we see stock purchase. The company purchased 3.2 million shares at an average price of 16.26, and it also purchased an additional 1.7 million shares at an average price of 17.38. So very, very strong indication that UiPath is a company that believes in enhancing shareholder value, which we really like from an investment standpoint of view. Whenever a company buys back shares, it increases the net earnings attributable to its shareholders. Although the company is issuing stock-based compensation expense to its employees, it's trying to reduce the dilution by repurchasing its stock once it turned cash flow positive through its operations. Now let's take a look. The company UiPath is able to generate cash flow from its operation, and if we exclude the stock-based compensation expense, the company has net positive cash flows. So let's take a look and see if the stock-based compensation expense is justified. Now UiPath, if you look at it in the past year, in 2023, it issued a stock-based compensation expense of $99,298 on average to its employees, and that compares against another data-based growth company, Palantir, which issued 120,351 per employee, and Airbnb for comparison issued $136,000. So all in all, UiPath, though it's been issuing stock-based compensation to its employees to retain all their high-performing and good employees, it's still issuing less stock-based compensation per employee compared to other similar companies like Palantir and Airbnb, which issued much higher stock-based compensation expense. So we think that the issuance of stock-based compensation is justified just to retain its employees and to enhance their engagement in the organization. Now let's take a look at who the current investors of UiPath are. UiPath raised in 2017 of April Series A with 200 customers at a valuation of 140 million. It raised another 153 million at a valuation of 1.1 billion in March 2018. It closed Series C funding of 225 million at 3 billion in 2018, and this round was led by Capital G, right? So Capital G is an independent arm of Alphabet, the parent company of Google, which invested in UiPath, and it also had another major investor, Sequoia Capital, and Axel led both UiPath Series A, Series B rounds, also participated in this round. In February 2021, UiPath also announced its 750 million Series F funding at a post-money valuation of 35 billion. And this series had investors including Altimere Capital, Dragoneer, IVP, Sequoia, Tiger, and funds and accounts advised by T. Rowe and Rowe Price Associates. So again, very strong indication about the company's growth potential as indicated by the list of investors, which include Capital G and Sequoia Capital. Now, the stock price of UiPath is trading at $22.17, and we have seen in the previous slides that the company holds close to $3.50 in cash, which is very, very positive. And the company's valuation is sitting at 2.61 billion if you look at the numbers indicated at the bottom. The PE ratio we still can't determine because the earnings are still negative, but we think the operating leverage being very strong, it's sooner or later it sooner is going to turn a positive net income in another 12 months. So we think UiPath has potential to grow another 2.5x in medium term and 5x in long term. Now, some of the indications from an investment standpoint, revenue growth is very positive. The revenues or the top line is growing at a CAGR of 33%. Earnings growth and earnings per share growth is also very positive, though negative at this time. It's soon, we think in 12 months it will turn positive. The company has a dominant market position as indicated by Forrester and Gartner. The total addressable market is again growing at 30+% CAGR. The company does not require any capex because it's a service-based company, and all the R&D costs are expensed in the same fiscal year. The company has generated positive cash flow from operations close to 150 million and is also buying back shares. The company spent $50 million buying back its shares, which indicates its shareholder friendliness. The company is having operating leverage as we looked at it. The company's top line grew by 20% and expenses grew only by 2%. Strong management team. The company is founded by Daniel Dines, and now he also hired a co-CEO in the form of Robert Enslin. Robert Enslin was the president at SAP company, and he was also the Google Cloud president for a few years. Then he joined UiPath, and and Robert Enslin is acting as the co-CEO. So we think the management team is pretty strong. The company has global presence. UiPath has over 10,000 customers, and it has diversified customers across multiple geographies, which eliminates the risk of having one single customer. Now, here are some question marks to consider. Long-term competitive position from a technology standpoint. What will happen in 5 or 10 years? It's a bit hard to guess. Will it still be able to retain its competitive position? Will there be any government regulation which will impact its position? For example, excessive automation. Will excessive automation be impacted by government regulation, which we don't know, which we think the probability is very less? Will there be any threat from Indian and Chinese companies? Maybe. It's a long it's a low probability, but we never know. Will any Indian and Chinese companies will be able to produce a low-cost robotic process automation that can compete with UiPath? We don't know, but the probabilities are less at this point. At this point in time, will there be any management issues? Will there be any conflict between the two co-CEOs? The one co-CEO is the founder chairman Daniel Dines. The other co-CEO is Rob Enslin. Will there be any conflict between the two? We don't know, which will lead to any downside. So from an investment standpoint, it checks most of the investment criteria, and there are some long-term questions which we think would be true with any organization. Now, we think UiPath has the potential to grow 2 to 3x in the medium term, that is between 2 to 3 years. So the current stock price of 22 could go anywhere between $50 to $75 in 2 to 3 years, and it could also reach over $100 to $125 in 3 to 5 years. That's our expectation. We're not fully sure about long term, but definitely in the medium term, we think 2x is a definite possibility. So anyone who invests in UiPath stock in the next month or so could probably expect to earn 2x returns to 3x returns in the next couple of years, just because the company is going from a negative net income to a positive net income, which creates which is a significant milestone in a company's lifetime. And the company is also having phenomenal operating leverage, where all the benefit in the top line is getting passed on to the bottom line, and the only investment that the company is making is in the R&D to strengthen its competitive position. Again, this is by no means a recommendation to buy this stock. This is our view. Please use your own judgment to make a decision if you want to buy this stock or not. If you have any questions, please feel free to drop a comment at the bottom of this video. Thanks, and have a good one.